covers at terminus below the morning session low. And then, and only then, the market goes back into sloppy choppiness, getting ready for another day of the slaughterhouse on Thursday. So this year I've talked about a number of things repetitively, and I've said certain things about the opening gap, and I said to extend that through the entirety of the week. As long as we keep coming back to it, and we're not moving decisively away, we're not in a trending model. We have to trade short-term price fluctuations and look at buy-side liquidity, sell-side liquidity, inefficiencies, and be nimble. Take our setups, get them and get out. Don't fall in love. Don't marry the vein. Don't go in thinking, oh, this is a short-term trade intraday, but now it looks like it's really going to go higher. Let me hold on to it, because you will see it reverse on you. How do I know that? How do I know that you have to trade that guy? Because we keep coming back to that weekly gap opening. Think about it, folks. If this market was going to tear off, it would have done so, right? And would it be coming back to this opening gap on Sunday? No way. Absolutely not. So use this insight going forward. Yeah, I promise you, it isn't me just using it when it works, because I've already taught this and my students use it. It's something you trade with in perpetuity. You use it in the future all the time, because it's going to repeat. It's absolutely going to repeat. Look at the logic that I've already outlined before tonight. It's in this chart right here. It's doing exactly what I codified, exactly what I trained you to look for. This is exactly how it's coded. And it repeats every week, every day, and it won't stop. So if you found this one insightful, and I don't know if I'll live stream tomorrow or Friday, but I will let you know by way of Twitter tomorrow how I feel. If I feel like I'm going to have the energy to do it, then I'll do it. If not, we'll do it on Friday. Okay, but I will certainly do it by Friday, if not tomorrow. And the only way you know is on Twitter. Until next time, be safe. wants to keep going lower, and it first has to break below that low. And again, that's the fulcrum point. So whatever move it has done from that low to high, it's like a measured move idea, and swing down to like that. I got this from that series from Larry Williams from 1995. He had this little transparent piece of plastic that had several lines on it. 1, 2, 3, 4. He had four lines and a straight line in the middle. He called it his target shooter. And I just basically said, well, I'm just going to use the perfect measure move here, and that'll be my target shooter approach with just using the fib tool. Right at this level here, I'd like to get another partial off there. So I talked about last night in the, what was it, the market review, that new week opening gap, which is abbreviated as NWOG. I know it seems like I'm trying to confuse you. I'm not. It's easier to do these little small letters to describe it. The concept has a lot of words. It just makes it easy. And also, it's real quick for me to type it when I'm doing live examples. And I'm trying to record them for Twitter. It's easier for me to type those letters and you know exactly what I'm looking at or what I'm referring to, versus sitting here trying to type the words and then most likely by getting it wrong, then my obsessive compulsive flares. And the whole time the market's moving and I'm trying to focus on all that. It's a little bit more difficult than it probably looks. Small little volume imbalance in here. I'm watching that. What's nice is you guys can actually turn this into real high definition and then zoom in on the chart. So whatever doesn't appear all that crisp and easy to see, you can zero in on an area and just zoom in with your phone or your screen on the computer and see real close and real tight. I was saying the new week opening gap last night on the live stream. I guess it was a live stream on it. The levels I had on the chart, and I was referring to it as the new week opening gap. I was half right, meaning that I was showing this level here and the midpoint between that level, which is the high on the new week opening gap, which is technically Friday's closing price, and this level here, and then I split that in half, and it was the midpoint of that, which is the upper quadrant of the entire range of the new week opening gap. And I had forgot that I was talking to my son about it, and I had that chart annotated with that, focusing on that specific range, teaching him. And when I opened up my charts and started doing the live stream last night, I was like, oh, this is on the wrong one on the hourly chart. And I realized really what I had done. So I immediately went onto Twitter and tweeted the entire gradient new week opening gap. So that way you can see each level. And all that is simply taking a fib and laying it on the low to the high, finding 50%, and then from 50%, lay a fib there to here, and then 50% behind that. Or you can just simply do a 25, 50, and 75 level on your fib, which is simply going in and changing the settings. Just a little bit more, honey. Just a little bit more. It's like my wife, she wants me to give her money. Just a little bit more, honey. To which I say, just a little bit more, honey. No ratchet ICT here. Come on. Here we are. One more time. There we go. Very nice. Can I have a little bit more below it? So now what I'm looking at, since I already had this target hit, I'm looking at this one here. And I have 2 contracts remaining. I don't necessarily need to have the 40.9850 or the 40.99 level. For moral victory, it would be nice to see it hit there today because I can say, well, there you go, screenshot that, and there's some more evidence. But what I want to do here now with the 2 remaining contracts I have on is I want to eyeball and see if it can go to the midpoint between this target, which has been met, and I took a partial at, and this level here. So if it can reach down to about halfway, I'll close one more. And notice I'm not worrying about my stop loss up here, way up here, completely out of mind. I'm not worrying about it. It's not a point of concern. I'm focusing on price action because this is a really weird, fickle day today. And this morning, this is for the jokers that like to come in after the fact when they haven't posted anything live, they haven't caught anything live, they don't show any of their examples or executions, and they go on their live streams and lose $15,000 max loss on their live stream and think that they're somehow a mentor. But when I'm tape reading, I'm taking your attention into specific PD arrays and I'm telling you what I want to see. That's not the same thing. It's not the same as going in and taking a trade. They're not trades. Okay? I'm not getting wrecked. Okay, I did get on in a trade this morning and it did come against me and I closed it. And if I would have held onto it, it would have stopped me up with a larger stop loss. So I wanted to engage that way I could have something for you, but it just was simply not wanting to pan out. And also, I like to take a trade when I don't really have a good feel for what it is I'm looking for. So I'll put on a very small trade, usually 1 contract, maybe 2 to get me wanting to feel closer to what price is doing. And this is also something you want to do with your demo account. Even when you start trading with live funds, you should have your demo account at the ready because in the beginning, if you're trading in the morning session, it can be really indecisive. Even though you may have a bias like we outlined this morning, I was expecting an opportunity to go short. That was the real main focus, but I don't mind taking a long to ride up into that 4070.25 level, which could have very easily been rated. I was looking for that trade specifically to go short at, and I was going to try to nail down the high today so I can get on Twitter and gloat. That's what I was trying to do, but it wasn't working for me. It wasn't trying to get up there. So it is what it is. It didn't deliver. It didn't go there. But when I'm calling out specific PD arrays, your attention is placed on that specific area. Now, some of you, and it's probably the ones that are real quiet today, you probably looked at that and think, oh, it's a trade. Let me go in there and push the button. And you've learned the valuable lesson today. I told you not to take trades on the things I'm telling you because you don't know what you're supposed to be deriving from that until you go through it. So as I was going through the motions this morning, my son's sitting next to me. He's like, Dad, like, I'm trying to close my eyes and listen to what you're doing because I'm saying it out loud. I'm saying it out loud, and you're just basically seeing a tweet. So he's trying to feel out what it would be like for all of you. You're seeing a tweet. You're seeing levels and things I'm referring to, but you're only seeing one piece of it because I'm forcing you to go into the chart and look at it, engage that very candle, that very concept, and try to get a feeling for what you think price is going to do next. The uncertainty, you have to embrace that. You have to do that part, and it's a scary feeling, especially if you're trying to do it with a live account, which is why you don't want to do it like that. And you shouldn't be doing it with a demo account either. You want to read the tape, get a feel for what price is doing, and just simply because I'm calling out a level, we're waiting for certain things to occur. A fair value gap doesn't always necessarily mean once it trades down to it, it's a buy. Sometimes I want to see it trade down to it and through it and come back up and act as resistance. But when I key your attention up to it, that gives you time. It gives you time to, okay, this is what we're focusing on right now. This is where our point of interest is, and let's see what he says next. So one of the things you're going to fall victim to is fearing missing out a move. Well, like today. So I know, listening to my son, he was thinking, like, Dad, what do you think the number of traders were today that were trying to do something with everything you were tweeting? I said probably about 30%, because they've seen me calling certain things pretty consistently, and knowing what human nature is like, they're going to want to try to pursue the next move. And I started feeling guilty about it. So much so that I was like, I'm going to have to break a rule and just simply call it out plainly when I'm going to take the trade. So I tweeted, said I was going short, and apparently the entire world was listening, and they all dogpiled on top of it. So I think that was interesting. But that should have fixed your boo-boo, okay? If you've followed me this morning and you're trying to press the button prior to that, that should have corrected you. Or here's the worst thing. You didn't do that because you hurt yourself doing something you shouldn't have done, and then you watched it do this. And now you're feeling the very things I talk about in my Twitter spaces, the psychological effects of all that stuff. Watch that midpoint between those two levels. As I'm talking, my eyes right in between. I know it's probably going to jump down there when I'm doing this. Right here and here. So halfway between that. This is what I'm looking at right here. So 41.03 and a quarter. If it touches that, then I'll peel off one more. It may not do it. I could be wrong and it goes the other direction. I don't care. But I like the idea that we trade up into the volume imbalance I mentioned live here. And we've delivered away from that. We had a sell side imbalance, buy side inefficiency. We came up into that, left a small portion open. I like that. We're in new lows, but I only have 2 contracts left. So I'm willing to risk it for the biscuit of hitting down a little bit deeper for here and then getting out on that one. Gotta risk it for the biscuit. Just a little bit more, ICT. Just a little bit more. Thank you so much. Thank you so much for this cherry picked. Is it live or is it Memorex? Uh-oh. I'm showing my age. What the hell are you talking about, ICT? Older folks know what I'm talking about. Is it live or is it Memorex? Was it Memorex? Memorex, yeah. Come on, man, get this take profit thing here. All right, so if I want this level, I'm going to come off of it 1 tick. And then we'll see what we get. Take that off. I want to come in here a little bit tighter and show you that volume imbalance. Right here. So when we're watching price action, and I'm on Twitter and I'm calling specific things that draw your attention to, this is the equivalent of majority of what you're seeing tweets about. Okay, so if I'm looking at, say, well, for instance, this volume imbalance right here. Did you see me take a trade there? Did you see me enter it? No. It's something for you to watch and measure order flow. Order flow is how you're reading how price moves from one level to another level. I outlined between this level here and this level here. I wanted the 50% level of that, which was what? 4103.25. What's the low of that candle? You're looking right up here, okay? The low of that candle comes in at 4103.00. Okay, so because I was doing it manually and doing it as it hits it live, I aim for trying. That's the part of the game I use when I'm doing my manual exits, because I know I'm invariably never going to get the perfect exit point if I use my limit orders on a specific level, because I've been accustomed to being, unfortunately, permit me to say this without seeing it as an invitation for you to be critical to yourself, but I don't like when I use a limit order when I'm trying to be very, very precise with it. Like I'm trying to get the low or the lowest tick. I'm very, very frustrated when my limit orders don't get it and it goes past it by 3 ticks or just one handle. So what I like to do is I like to see when it happens live, and then I try to time it. It's kind of like that game when my kids were little. They used to want to go to that Chuck E. Cheese thing, and there was a game. it would spin around like, well, nothing's really spinning. The lights would go around like it was spinning, but you have to time it. You got to hit this thing, and wherever it stops, you would get the respective prize, whatever it was stopping on. So I treat it like that. So I'm trying to hit it like as it hits the level I'm interested in. I'm hoping that I'll have positive slippage in my favor, and then give me the better exit. And sometimes my exits are very nice. I'm satisfied with them, but most of the time they're not. Like, I'm not satisfied with them. You look at this and you're thinking, well, what are you complaining about? 30 years of trying to pursue perfection, and it's a compulsive tendency for me to criticize my own exits. Being profitable is not the point. The point is I want them to be perfect, and I'm never going to have that. But as long as I keep aiming for it, what's it going to do? It's going to make that skill set better. It's going to make it better each time. Now, see, I'd like to have more than one contract on still, because then I could take off one more as it was hitting that low here. This low comes same level 41.03 even. So now when we have levels like this, see these wicks here? We have a wick there, this wick there, we have a wick here and here, and it's just one single candle. I don't want to see it trade back up into that area. I want to see it remain heavy, because we've had multiple times passing through that range. So it should act as a balanced price range and not want to go back up in there. Because if it does trade back up in there, then it's probably going to have a deeper retracement and come back up into this area, which in my mind is problematic for me getting to my target, which is within an earshot of where it's at now. So when I'm calling out PD arrays, specific fair value gaps, volume imbalances, I'd like to see it do this, I'd like to see it do that. The worst thing you could do is read into that thinking, oh, he's communicating that's a trade entry. So the goober out there that's an S&P specialist, Mr. Talker, that I did not fail and blow out 3 times in Robin's Cup. Fools. Every time I mention a PD array, every time I do that, it's simply me giving you a reference point, like I mentioned here on this one, talking about the volume imbalance, just like I was calling it live in yesterday's market review. I was talking about very specific things. Watch the reaction to price. And what you're doing is you're measuring, does it respect that? Now, what would have happened if it would have traded through it? Am I going to go into a tissy fit and say, oh, and huff and puff and be mad because it didn't respect that PD array? No, I'm taking that as insight. I'm reading it, internalizing it, and saying, okay, it went through that one, so what's the next one I have to be watching? Because if it breaks through 3 of them, then I'm probably not on side anymore, and my interpretation of order flow is not accurate. So if I have a stop loss that's likely to be hit, I can do what I did today and neutralize it and not let the stop be hit at all. Now see what we're doing here? We're trading up into this area, which is what I said I didn't want to see it do. Because it's doing this and trading up into here, my eye is right here at the mean threshold of that candle, this up close candle. So for specifics, I can't tell if it's a 5 or not. Old eyes. Yeah, 4107.50. If it goes through that, then I'm probably going to close the trade and be content with it. And that's that. So these are the things that plague me as a trader. I'm wanting to see certain things be given to me at my exits. Let's go back down in. Now, what happens if it goes down and hits my level and keeps on going lower? So that's the part that I don't feel frustration for. It's when I'm really trying to key up on, like what I was doing in front of you here, managing and trying to get the levels that I wanted for precision. Closing the trade because it doesn't any longer hold the likelihood of delivering like I want to see it deliver. That rule has served me more and better than me trying to be finicky and try to finesse my exit strategies pursuing perfection. Meaning that if I'm in a trade and I'm looking for something to indicate to me that I'm probably no longer in a move that's going to sustain and continue to my objectives, this still could do that. And I'm okay with it, because there's many times where I would have discounted that whole idea of saying, okay, if it goes through that mean threshold here, I'll be willing to sit through it, and it might do what it's doing right here, and then all of a sudden go the other direction. And then I would be really upset with myself that I knew better, but I didn't engage on that. I would be mad about that. But I don't get mad about me doing this, closing the trade, because it's now meeting a criteria that means that I have been hurt in the past by not sticking to that rule over something so insignificant as a move from where it was and trying to get down to my objective. So it looks like it might hit that 40.98.50 level. So reading and interpreting each individual PD array helps you without having to have any kind of like depth of market on the right hand side. There's ladders and such, or volume profile. You don't need any of those things. You just need to see, does price continuously keep offering resistance in the form of the PD arrays, the things that would key up a new trade, not necessarily that we're taking a trade or that I'm entering on a trade, like the volume imbalance that was mentioned here. Watch that. Did you hear me say go short? Now, some of you probably went short there, and you probably already took profits based on the lines that's already been here, me closing my trade, and you probably mimicked that, and you're doing everything wrong. But every time I mention a specific element of price action and the things I'm teaching you, you're looking at that and seeing how this price react to it. Now, the reason why I'm teaching this and teaching this way of doing it is because you don't know, I don't know, which specific model or approach and what is your multiplier going to be. What's the PD array that you're going to use continuously more than anything else? Is it really a fair value gap, even though you probably have warmed up to the idea because of what I shared, what people are making money with now? But that might not be the one you settle in on. It might be a volume imbalance. That's your pattern. That's the thing you look for. That's the thing that gets you in a trade. But you won't know that until you do what? Have someone that's going to be identifying them real time, whether it be like this or whether it be on my Twitter feed where I'm calling out the specific candles, saying, okay, note this one, pay attention to this one. That's not an invitation to buy or sell. That's not what that is. Clearly, you can see if I want to tell you I'm going to be in a trade, I did it today. I don't want to do that part because you're not going to learn anything from that. By watching price and seeing which one of these PD arrays, breaker, order block, fair value gap, optimal trade entry, institutional order flow entry drill, mitigation block, whatever one that you see when I call it out, it will repeat over and over again. The ones that you see clearly, that's easy. Oh, I saw that. I was looking at that. I knew he was going to mention that, referring to myself when I'm talking about it. Then that's the one you're probably most suited for. And doesn't that make much more sense? Learning from someone that allows you to bring something of your own personality, your own comfort, your observations are peaked around a specific element in price action that makes sense to you, versus me saying, listen, you're only going to be able to trade the fair value gap. This is the only way you can make money. That's too dogmatic. And sometimes I can come across like that in some of my animated lectures and talking points. But I'm a realist and I understand that that's not going to fit everyone. You're all going to have your own personalities and quirky little things that you bring to your trading. And you have to make allowances for that. And I certainly have to do so as a mentor, as an educator. It's a testimony to a good teacher that you give the student the opportunity to discover themselves using the concepts, using the principles that you're teaching. So that way it allows them to feel confident in themselves because they brought their own expression, if you will, or personality and internalization of price action, but using the same tools. It allows you as a student to be more hands-on on the actual development of the model versus me saying, here's the only way you can trade my concepts, which is never going to happen. There's lots of different ways to do what I teach. And each one of you can have a completely unique model using the same stuff I've taught. It sounds crazy, I know, like it couldn't possibly be like that, but it is. And you want to have a mentor that's going to be able to give you that opportunity. And unfortunately, there's so many copy me, mimic me, come here, we'll have somebody that's going to earn your funded account for you, or you don't pay. You've seen those ads yet? Yeah. I think they changed it to, if we don't get you funded, you'll get free signals from the guy that's going to do it for you until you do. Well, that sounds less than a refund, right? Anyway. So all the things that I was calling out this morning, every individual PD array, that that skill set that you're looking for as far as reading price, the days I'm not live streaming, and there'll be times in the sessions that I won't be active on Twitter, and like I didn't want to really do anything today because I feel like someone's sitting on my forehead. Like I have a lot of pressure on my sinuses, and it's probably more information you want to hear about, but I just don't feel well. But I know that Friday's tomorrow, and if I am getting ill, I'm going to be more inclined to want to stay in bed tomorrow, and I won't be able to hit the second live stream that I promised you that we would have each week going forward. So here I am doing this one. So I'm going to kind of incorporate a little bit of a review in this too, so kind of like two birds with one stone type thing, kind of like what I did last night. But when we have time away from each other, when I'm not talking to you via Twitter and when I'm not doing a live session, you want to be doing live tape reading when you can. And if you can't, then you do it with old data that you preferably recorded live on your screen, just let it record all day, or watch it on market replay, which is unfortunate because that's not the same as watching the candle form. Every time it goes up, it just created the equal. Now it went higher, 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 then it comes off the high. So you don't get that market replay. You get the open, one little change, and then it closes and goes to the next candle and does the same thing. So there's like only like 2 fluctuations per candle in TradingView's market replay, which to me, next to nothing, it's good, but it's better to use a resource where you can record your screen and let the chart just paint while you're sleeping, while you're at work, while you're at school, while whatever you're doing. And that way you can come back and study it real time and pause it. When you think you see something, pause it, screenshot that, annotate it, and then let the chart paint going forward again. And that is the best way that you can do. If you're not watching it live, that's the best way of doing it. So if you're, I guess, capable of using OBS, which I'm still fumbling around with, that's what I'm using to live stream. It tends to be like the most popular medium to use, I guess, but I'm not an expert in it. But I think it was pretty easy to get to this part. So you can record your screen with that, and it didn't cost anything. You just download the app off of the internet and then just record. Set your charts up, set them up to record, and just go do whatever you're going to do, whether it be sleep or work. And then when you come back, sit down, roll your sleeves up in your own comfort of looking at the charts where you're not distracted, you're not worrying about what I'm saying, and probably maybe do that on your weekends instead of watching the football games and golf. Why do people even watch golf? Like I get the fact that dudes want to go out there and hang out and talk it up, but I can't get into that. Like I don't even see that as a sport. But instead of doing those things on the weekend, and please don't, because you probably like golf and such, but I don't even know why that jumped in my head. But I'm not a big sports fan, and I just think that the weekends are wasted on that type of thing. And if you're doing that this year, you're wasting really good opportunities. Watch this area over here, the remaining balance of that gap between that high and this low. That little tiny area, yeah, that's what I'm looking at. Because this is for a gentleman I promised I would talk a little bit about today. If we are, let's assume for a moment that you were expecting price to go down to that 4103 level, okay? And you saw this setup up here. You saw price trade up into this fair value gap. Let me move it away so you can see it. This candle's low, this candle's high, and this candle passes through between the previous candle's low and the next candle's high. There's no overlap of this candle up inside that range until we get to here. So that little shade area that I put on my charts that my students do now too, that little area is where, if you were looking at a paint roller, and the paint roller applies paint to the wall, rolls down. This little area is like a pocket of where the paint wasn't really thick. It wasn't evenly distributed to the wall, and the wall would be like this chart canvas. Like if there was no charts on this at all, it would be a blank canvas, like a wall, before the painter puts the roller and delivers the paint on the wall. Well, as it drops down like this, from here to here, this is where, like when you take that roller, if you ever painted anything or watch a painter use a roller, when they first apply that roller to the wall, the paint is really thick. It's ample. It's delivered abundantly to the wall. And as that roller continuously rolls in the direction it starts rolling in when you first apply it to the wall, eventually there'll be small little porous little pockets where paint did not distribute to the wall. So the surface of the wall will have what? Little spots. And that is much like what we're seeing here, where the paint comes in, it applies to the wall, keep going down. But now if you look back, there's a small little area here where, in an ideal world, the painter would take that roller, apply more paint to it, and then do what? Roll back up over top this little area and this little area. And then he can move on to another area of the wall where he hasn't painted yet. Does that make sense? To me, that makes sense as an analogy, because if that would have been taught to me when I first learned how to read price action, it would have made a whole lot more sense versus overbought, oversold. What swing high is the real one with divergence, and what trend line do I use? What's my moving average settings? What RSI settings should I have my set on? What, do I use MACD histogram, or do I use the moving crossovers? All the stuff that was a waste of my time. These are the things that would have been more beneficial to me, which is the nuts and bolts of price action. So looking at where the market can go back in and do what? Replenish paint to the canvas. Put more paint back in an area where it needs it. So when you look at price action and you identify these little areas like this, you think it's going down here. See, the painter needs to paint down to this level here. To finish the job, the price run, the algorithm will want to go down there. But it has to do what? It has to deliver the market efficiently. Otherwise, it's a straight line like CPI. When that market data comes out, what happens? The market's just doing nothing until CPI number. All of a sudden, you have a vertical line. That's it. That's it. It's all you have is a vertical line that keeps expanding. You can't trade that. You can't do anything with it except for regret that you were in the trade. It's not going to respect your stop loss. It's going to laugh at you. It's going to literally make you feel like you're a fool and you should have never done that. And you should feel that way because the CPI is an absolute freight train. Like you're literally trying to play chicken with a freight train. It's coming right at you. Hit me. It will. Stand on those tracks. It will do that and drag you for miles, okay, until your account's gone or you lose your sanity. So you have to know where price is going to go. Much like a painter, when he looks at that wall, wherever he's going to start with, whether it be the left side of the wall, the uppermost part of the wall, or the lower part of the wall, wherever he starts, okay, that's the point of inception. When he puts that paint on the wall, now his job's begun. Now he has to paint the entire surface. Just watch anybody. Just go on YouTube, say painter using a paint roller, and you'll see exactly what I'm talking about in an analogy where, let's assume for a moment you're starting on a wall in the lower right-hand corner, and you apply the paint you put on the wall, maybe at the top end. You start there instead of the bottom. Top end, you apply the roller and you drag it down over the wall. The first 12 to 18, 20 inches of the surface of the wall has a beautiful delivery of paint. It's thick. There's no pockets. There's no porous little parts that got to go back and roll back over top of immediately. You just roll until what? You feel like you're not getting any paint coming out anymore. So what does the painter do? He rolls right back over that same pathway to gather excessive amounts of paint that's not necessary to be in that same area. So it's going to collect more paint, evenly distribute any areas that have these little pockets where paint hasn't been distributed. So it reapplies in old areas. Yes. What does that mean? In this area here, paint was, or price was offered both directions. So from this candle's high and this candle's low, the next candle opens up here. It trades back down and runs over top of what this candle's low was. And then it rallies all the way back up to this point. So it leaves what? It leaves this little area as a hole or a pocket where price did not go back over, where it went down in between this candle's low and this candle's high. This is inefficient. This right here is an inefficiency in price delivery. Price operates on a price continuum. Okay, it's a efficiency continuum, meaning that the market has to continuously offer fair value, and fair value is evolving all the time throughout the day. And every time it creates an inefficiency like this, it will seek that and go back up into it. Now, it will over deliver just like a paint roller will. The painter will roll back over areas where it's already had paint delivered to the wall, right? You've seen that. There's no way to do what? You can't just paint one little pathway on your wall and then come over to the left a little bit and come back down and not overlap. You want to overlap. And that's exactly what's occurring in price action, because look at the range in between here. This candle's high and this candle's low. The market has traded down and it also traded up here. So in this little area here, on a micro scale, this is a small little balanced price range. When the bodies of these candles came back up into this fair value gap, identified with this little area right there in price, that little segment right there, look where the bodies go. See where it stops? The closing price on this candle is 4116.75. What's the low of this candle? 4116.75. That's perfect. That's a signature that shows you the market's algorithmic. Retail logic, nothing out there says trade with these levels like this. Because if they did that, if they knew that, they would tell you where to put trend lines at. Whereas right now, up until this moment at the time I'm talking, nobody tells you what specific price levels to drop a trend line on. If you ask 1,000 different traders, say we had a live, like a session where I was in front of a stadium of people. I don't foresee me doing this, but let's just, for the sake of argument, say that's what we're doing here. And I said, okay, everybody raise your hand if you know how to use a trend line. Of course, everybody's going to raise their hand and say, yeah, this is what we do. And say I threw out a beach ball, 3 or 4 beach balls, and we bounced around until the music stopped, and whatever the music stopped, whoever had the beach ball in their hand, they get to come up on stage with ICT. And I said, okay, here's a chart. You all had the same chart. You can't look at each other. You can't copy. Draw the trend line that's most important to you right now. What do you see? And they're all going to be different. And you wonder why retail traders are inconsistent. They have no premise behind finding consistency because they're constantly doing something different and not maintaining a rigid approach with rule-based ideas. My rigid approach to rule-based ideas are my PD arrays within the context of market structure, within a bias that's been derived by a narrative, which is also leaning heavily on a higher time frame premise, which is a weekly chart. I'm doing the same things all the time, but the things I'm doing are very specific, like knowing a very specific level. This candle's low, 4116.75, happens to agree with the closing price on that candle. What's the next candle's body? It's the open. It's the same thing. The open price is 4116.75. Now, just like that paint roller, when it delivers over top of old areas where it has delivered paint, watch the painter, they overlap over it. Why do they do that? It makes sure there's no seams. It buttons up everything. It completely smooths out and feathers the edge of an old run on paint being delivered to the wall, and then you apply it back over top of it just a little bit. Kind of like when you cut the grass, the lawn, you cut the grass and you come back over, and you're not trying to line up where the edge of the last pass with the mower was. You're going to overlap it a little bit. Why? Because you don't want to waste your time going back there again, right? Well, that's why the algorithm is coded this way. It wants to efficiently go back and reprice. So you'll see these little areas here, which I'm going to borrow this now. This area here is where this candle's low. Let me take it away a little bit further and you can see the difference. So this candle's low. Right here, this candle's low, and this candle's high. High and low. It's passed back and forth between that shaded area, both directions. So when we have this pass back up into the actual fair value gap, that low to that high with this one single candle here, my eye is trained to look for that in price. I'm teaching my students to look for that too. You're going to try to enter in that. Where? Going short at that candle's high or the midpoint in between. You can, if you really want to try to be a precise, fanatic, you can try to get the fill at the high end, but many times I've tried to do that and it doesn't go there. It leaves a small little portion open. In this case, what I'm illustrating here is the efficiency of the algorithm coming back into an area that's already balanced, but it's covering up and overlapping an area where it's already traded to, which is why you're getting this and this. That's not an error. It's not a deficiency on precision either. It's just making sure there's no seams. Everything's been offered efficiently, but the bodies tell you the real story. This is where the damage is done to wicks. But the real narrative and what price is doing is you have to study the bodies. That's where the real storyline is. And you can see how it comes right up into there and stops. This part of these wicks, okay, you have to accept the fact that your trades are going to have that much drawdown. If you're entering in here in consequent encroachment, okay, in this range here, we have what? It's balanced. It's done both passes. This candle went down to this low, and then this candle opened here and then went up this much. So I'm not worrying about all this here. I'm saying the difference between this candle's low and this candle's high, those two ranges present a range of price action that has, in this interval of, 4 minutes? Each candle's 2 minutes. In 4 minutes, price is going back and forth in here. And you're going to hear other people say these lower time frame charts are noise. They're not noise. It's telling you what price is doing. Whether you're looking at this chart time frame or if you're looking at an hourly chart or a daily chart. If you're staring at a daily chart, is the daily chart, if you watch it from the time that the market's open at 9:30 to 5 o'clock when it closes for our hour session of dead time. If you simply watch price on that daily candlestick versus us watching on a lower time frame, is price doing anything different? It's doing the same thing. It's this, you're doing the same thing, but we're using the benefit of a time-based chart. And you're going to get goobers out there that are going to tell you time-based charts don't work. Time-based charts don't work if you trade retail logic. That is true, but I don't trade retail logic. We don't trade retail logic. I'm teaching you how to use time-based theory to identify what the market algorithm, okay? There's only one algorithm. That's the price engine that delivers this. You're never going to convince anyone, especially in this community, that these things here are being met because buyers and sellers that use retail logic all come together and through sheer coincidence, it just happens to be perfect. Come on, no. I don't even want to entertain that anymore. When I see people comment and say that stuff, I immediately mute them. I'll never see another comment from that person again. You're not being blocked from my Twitter feed, but I just don't want to hear from you because you're literally closing your eyes, putting fingers in your ears. No, you don't want to hear it. Okay, I don't want to see your nonsense because to me, all it's going to do is trigger me. I can't stand seeing people deny the evidence laid in front of them. It's right in front of them over and over and over again, but they won't appreciate it because it flies in the face of whatever they believe is the real things. And the things that they're holding on to probably isn't even this precise, which to me is madness. But I'm becoming a little too dogmatic here. Let me dial it back. So we have this overlapping into this area. What is this entire range? From this low to this high right there. Watch this. There's our fair value gap. Now, if you know that the algorithm is going to do the same thing you're going to do when you cut your lawn in the springtime when the grass is growing, you're going to go out there with your mower, or the guy that you're going to hire to cut your grass for you like I do, because I ain't cutting shit. The overlapping of that mower, where you just pass through, cutting the grass down, the first pass, then you're going to turn the mower around, or they're going to turn the mower around, and they're going to lay their wheel over top of what was already cut. So that way there's no seam, right? So when you make a new pass, you're always cutting through, and not leaving that little segment of grass where you got to go, oh, I left a mohawk. Got to go back in here. My sons, the few times I've asked them to do the lawn, they hate it because they know my obsessive compulsiveness is going to force me to go to the window and see what they're doing. And I'm waiting for them to leave a little mohawk in the grass. And as soon as I see it, I'm out there. Hey, go back and get that. And they flip out because they thought they were going to get away with it. But you can see it. You can see it in the grass. You don't want to leave that. So that's what these little things are here, preventing any little mohawks in the lawn. I know I'm giving you all kinds of analogies, but this stuff makes sense to me. If it doesn't make sense to you, then I'm sorry. But if you look at that balanced price range between this candle's low and this candle's high, there's our target right there. Screenshot that. And that's the level I told you here too. Pretty cherry picked, isn't it? I see T, you slay me. The range between this low and that high, if we measure that and you get a midpoint level, that is mean threshold. Why? Because we're measuring candlesticks that have bodies. If it were a gap like this fair value gap, the midpoint is consequent encroachment. Consequent encroachment is what is permissible within a range. Let me make this a little bit smaller. See if we get that 9850 level I mentioned on Twitter. Because I feel like a peacock if it hits that. My wife's going to see me doing the Mick Jagger walk. Got my moves like Jagger. Don't worry, I'll come back up to that balance price range in a minute. Some of you already figured out what I'm going to go and talk about in a second. Come on. All right, we'll give it time to cook. So over here, we have 4,117.50. It just so happens, randomly, with buying and selling pressure being as it is, completely random, how far can it overshoot this fair value gap? Well, what's the midpoint between this candle's low and this candle's high for that balance price range? 4,117.50. What's the high on this candle right there? 4,117.50. Whoops. So it takes more of a religious faith-based madness to believe that all these things that I'm teaching you, okay, all these things that I tell you to go in and look and see if they're really in the market, if they're really in the marketplace, it begs the question, how the hell does it keep happening? How does it keep happening? See, these are the things. I was sitting in my aunt's bedroom after working 13 and a half hours a day, doing a 45-minute commute in 20 minutes, speeding. I guess I was breaking the law. Never wore seatbelts either, and I rarely wear one still today. But I'm a rebel. I would sit in there and I'd look at these charts, and I started looking at these things and these turning points, and I'm like, what happens continuously all the time at these turning points? And I started seeing this in the bond market, in the S&P market. And then I said, well, let me see if it occurs in the currency futures. It was. It's there. So I said, okay, I need to know. Did I see something I'm not supposed to see? So I took all of my money. Every time I made new money, I would buy more books and more courses and more books and more courses. And for the yahoos out there that say that I have rebranded things, old terminology, rebranded with new terms, this stuff is in no books. No other author ever talked about it. It's never been touched on until I've said it. Which is the reason why I challenge every one of my viewers. I'm not just going to hit our target here. One of those, I told you so moments. Oh, look at that. That's so random. Acceleration down. I told you we'd probably get a big down day earlier in the day if we get through that new week opening gap. So I have a lot of fun. I'm not beating my chest. I'm just thumbing my nose at the people that like to say I can't do this, that these things don't work, and it's cherry picked. And I had a small win when I had the win of the day. I called everything you've seen it. It's here again. I want you to learn, but if you can't get out of your way of your own ego and your pride because you don't know this and you can't do it yet, and I'm probably killing your business because you can't sell your stuff anymore and you're getting on your live streams and losing $15,000 of fake money but calling it live. I get it. It's a struggle point for you. But I'm not trying to be your adversary. Just learn from me. You don't ever have to mention me. I just want to see you do better. And you don't have to communicate to me. If you want to keep it in private, that's wonderful. I just want to see all of you do well and not get hurt, because these markets are not random. They're not. But back to that balanced price range, and we'll see what we get later on. I'm going to focus up on here. Some of you are thinking, damn it, I should have closed the trade when he did. There's a lesson in there. So it nails that level perfectly. Then it moves lower, and it leaves this area here. One more time, trades to it, above it. One more time, making sure there's no mohawks in the lawn. It's seamless. And then it breaks lower. One more time, it trades up. What is it going back up into? Consequent encroachment of this gap, midpoint. Hits it. When you see that, as soon as you see that, you're thinking, okay, this is the last time it's going to do it. Why? Because this has already went up to the midpoint of this area here. And why? Because your targets, your terminus, the levels that you're expecting and looking for, that's where it's going to draw to. Just like when you're sitting down to figure out when you're going to cut the lawn, when you start making that mower pass over top your lawn, you know you got to keep doing it until you get to the end of the lawn. Well, the end of the lawn is down here, so you got to keep constantly doing what? Apply the paint to the wall or keep pushing that mower until it goes to completion. The completion is time and price. So we're in that last hour of trading, 3 o'clock hour. The market's delivering into our objectives. The one I gave you on Twitter, we already hit it, and it went past it. That's fine. But when it goes up into this level here, you're anticipating it to do what? Never go back up here. It has no need to do that. But what can it do? What's permissible? It can go back inside this fair value gap. Because why? This is an old inefficiency in price. Whereas this, the difference between this candle's low and this candle's high here, this is efficient. What makes it efficient? It's traded both directions in between this candle's low and this candle's high. So price is effectively permitting balance in order flow in price delivery. Price delivery is every time there's a new price tick and there's a new fluctuation in price action, that's delivery. That's the market being presented a new valuation on an asset. So what we're doing is we're measuring how often that delivery of price, how many times within a range specific to time, which is these two specific candles here, how many times has it passed through the same range of a specific number of prices, meaning that this candle's high here comes in at 41.18 and a quarter, 0.25. And this candle's low here comes in at 41.16.75. So between those two price points, price went down, and then this candle here opened, went up, and then went down again. So this entire range between candle high and candle low is balanced. It can go back up into the midpoint of that. That's normal. I allow for that. In my analysis, when I'm reading price, I allow for it to go up to halfway. It's rare that it will go all the way back up to the top of a balanced price range. It can. It just means that I'm probably getting ready to bail on the trade if I'm using that as a point of interest to measure if these PD arrays are able to stave off an advance or a retracement against my trade. So I'm treating these PD arrays like you are being taught to use support and resistance, but never get them to work right. Whereas the algorithm is going to go into these specific little signatures and price action that cannot be hidden from you. It can't hide it from you, folks. That should be exciting. It's not like they're going to be able to go out there tomorrow and turn off candlesticks. We all look. Are you going to stop using a clock? Raise your hand in the audience right now if you're going to say, the hell with this. I'm not using a clock. I'm getting rid of my watches. I'm never going to look at the time anymore. That's absurd. And that's the first primary function of what price does. It follows time. It does things at specific times. Then it delivers price based on the efficiency and the price delivery continuum. It has to continuously offer fair value. If the market runs too quick one direction and it goes down like it does here in this one candle, is it fair? And it's probably not the best term of using for describing this, but for the sake of making it easy to understand, because fairness is not really the goal here for these markets. But if the market drops down like this and leaves this little separation between this candle's low and this candle's high, there was no overlap, no other candle after this candle closes, no other candle printed within the price range between this candle's high and that candle's low, in between these three candles. If that small little segment of price action creates that little pocket, the little porous price action hole, it needs to be filled in. Okay, think of it like a pothole on the road. Okay, you're going down the road, hey, boom, you just blew out your front alignment. You're gonna call the state, hey, you so-and-sos, I just tore my thing up. Well, where is that? What mile marker? Let me go back. I gotta drive back up to it. There is a mile marker, and then there it is. Silly little analogies, but I use these types of things to teach my kids. And I tried to explain every possible scenario with my wife, and I still haven't figured out an analogy where it makes sense to her. She just thinks it's a video game, so whatever. But the fair value gap can be revisited entirely, and that's what we see here. Notice that these wicks trade up into that same old inefficiency, hits it here, hits it here. All this is a reclaimed fair value gap. Reclaimed means it simply went back to it and treating it as you would expect a resistance level to be respecting. If it's going to go lower, it's going to do what? It's going to go up, fail, go up, reject it, and send it lower. Wonderful. Wonderful. That's exactly what you want to see. You want to see that. You should not be freaking out when the market's rallying up back to these areas here, because we have this behind it, this balanced price range. This is kind of like the defender. Okay, it's the linebacker of price action. It's saying you can only go so far, Jack. You're not getting through me. It's the iron wall. Okay, you're saying no, can't get through me. So everything's coming short of that or falling short of this. Hang on one second, I gotta fix these headsets. Really uncomfortable. So if we see any kind of retracements back up into a fair value gap, that's reasonable. And you're going to see me explain this, and you're going to see your experience seeing it happen. When I'm calling specific fair value gaps and it returns back to them, sometimes it'll go through them, like we were looking at this morning. There was nothing in there for a trade, nothing, until I saw one fair value gap when it retraded back. I said, okay, we're going to use the fair value gap again. I tried to take a trade on it, and it just wasn't working out for me, and I had to kill it, and I would have stopped out, and I mentioned it on Twitter, if I'd have held my full stop. That's human error. You're gonna do it wrong too. You're interpreting price, and you're seeing objectives. I'm also trying to teach as well. But when you see these PD arrays, you're going to learn their characteristics because you're looking at them. This is what's usually occurring when someone watches my videos. Number one, they're not interested in listening to someone really expound on the logic that's required to know how to do this. If you are lazy, and if this offends you, unsubscribe, don't ever watch me again, okay? Because this is for the people that really want to understand and learn. If you are lazy, you will not learn how to do this. There's no shortcut to it. You will go into charts, you will study, you will look at old data, you will backtest, you will tape read for months and throughout this year, and that's how you get good at it. Here's who's going to fail. Pushing a button, getting into a trade, whether it's demo or live. You will not be able to learn this because you're not getting the same type of feedback and insight by looking at these things I'm calling out on Twitter, or when I reference it. Like, I just did it again in front of you here again today. Were you all here? I mean, did you see me not say, watch this volume imbalance here?